Justin Nault here. I am extremely excited about my guest today because we're going to venture away from the land of fitness and nutrition for a little while, and we're going to talk about all things personal finance. My guest today is Garrett Gunderson. He is the founder of Wealth Factory and a best-selling author and all-around financial genius. This concept of cash flow banking, which I'm now involved in and super thrilled. I pulled the trigger with Dale Clark and Mass Mutual. And like, dude, if I had known about this in my 20s when I was like killing it in the music industry, I'd probably have 10 of these things. But here's a random thing I want to talk about. This is very personal for me. And I know that you're going to be like, oh, okay, I totally get it. In the world of nutrition, people will change this like high fat, low carb diet and their entire family tells them that they're going to die of a heart attack. And this is terrible for them. It's these strongly held false beliefs again. So I was recently in Mexico with my dad and my brother. Like 2 days before, I had signed the paperwork for Mass Mutual at Dale. I'm like all excited. Didn't talk about it. Didn't tell anybody about it. Nothing. Now, randomly in Mexico, we're talking business and finance. And my brother says these words. He goes, yeah, man, that's like someone telling you to buy a whole life insurance policy, which is the worst financial advice you could ever give someone. Now, the kicker is my brother has 2 degrees. He has a degree in finance and economics, and he's a lawyer. And he's basically a genius, right? And so he says this, and now my newly held belief, I'm like, oh no, like did I do something terrible here? But it's like you said, he was taught what he was taught in school. It doesn't make it right. But where does this stigma come from for cash flow banking?
Well, first off, 90% of the policies are designed terribly with companies that aren't really suited for it. So it might be 4 or 5 years before you see cash.
Right.
So because if they're designed with commission in mind versus really what's best for you, then that's part of the problem. So they deserve that rap because like in my book, What Would the Rockefellers Do? I say, well, Dave Ramsey and Susie Orman would rail against cash value insurance.
Yes.
And I go, well, here's where they're right. When it's designed this way, it does take forever and it's going to underperform. Here's where they're wrong. They're only looking at expense. They think of it as an expense and they want to lower expenses to lower the amount of money required in the budget. So they're not looking at it from the benefit standpoint.
Sure.
So it really is super popular with the highly affluent from an estate planning standpoint. It's especially with private placement life insurance. But when we look at whole life, when I first learned about it, someone said it's a hole you throw your money into. Showed me some of the old antiquated policies and the way they were designed. And I'm like, yeah, these are no good. But when they're designed properly, then we treat it like a bank treats their reserves. A bank puts a portion of their reserves into cash value insurance because it has a higher return than their reserve rate. It has more protection. It has more tax benefit. So it's simply because so many people have not designed it properly that it gets that kind of bad rap that it deserved.
Yeah, totally. And it's interesting. So I'm a big believer in the universe and stuff. I kind of get the feeling you are too. But I had read Killing Sacred Cows was first for me. Then What Would the Rockefellers Do? And then I had to wait till Budgeting Sucks was released to read another one. But like after What Would the Rockefellers Do? I would go down this rabbit hole and I end up finding, Ryan sends me Heads I Win, Tails You Lose. I read Emily's book, The Bank on Yourself program. Then I'm listening to Ryan's podcast. All these people like you, Dale Clark, Ryan, Patrick, Emily, the author of The Bank on Yourself. I think you said her name's Emily. But like, I heard all these people say the same thing of like, oh yes, the core foundation of my finances is overfunded whole life insurance. And I'm like, whoa, how have I never heard of this thing prior to now and this crazy stigma thing? So I mean, I'm thrilled to have it now. I don't know if you want to touch on, I know that's like a big lengthy topic, but if you want to hit just bullet points of cash flow banking, it's pretty unbelievable. I'm sold on it.
Yeah, cashflowbanking.com is the site that I endorse for it. It really comes down to like overfunded whole life policies. The reason whole life, a lot of people are using indexed universal life. That's not cash flow banking because it has too many levers and risks that could face in the future. Whole life has guaranteed premium, guaranteed cash value, guaranteed minimum interest rate, and guaranteed death benefit. When you put more money into it, it goes straight to the cash value. It can push the death benefit up. That's known as paid up additions. Mm-hmm. So there's a capitalization period. Your first year, you're not going to have what you put into it. You might have 50, 60, 70% of what you put in after the first year. The second year, it gets a lot closer. Third year, by the fifth year, somewhere between 3 and 5, you should be at break even. And then from there, you're just going to wall up your savings account because your savings account is going to earn 2% taxable. My policies have been over 5% tax deferred, but I can access that money tax-free. I don't have to wait till 59 and a half. It's protected from financial predators and bankruptcy and liability because of the way it's designed. I don't have to buy term insurance because I have a death benefit that's attached. I'm dealing with, Mass Mutual is a $1 trillion company, the one that you mentioned you had a policy with.
Yep.
They've got a pretty stable structure that's behind them in what they're doing here. And they've been around for 150, 60 years or whatever. So they've survived recessions, depressions, and wars. So like, I like it as a place to be my midterm money. Now I can use that cash to buy things like investments or businesses, and I can put it back on in my own terms. But right now I just got it sitting there. Why? Because it's getting more than 5% where everybody else is losing money in the stock market, and it's secure. So once there's major deals and opportunities, I might use that cash to buy something, to buy a business, to buy an asset that's distressed and depressed.
Yeah, so I haven't found a good way to explain this to people. It makes sense in my head because I've read all these books, but can you just detail, like, I can borrow right now, I've had the policy for like 60 days. I can borrow the money from my whole life policy, have that cash on hand, but it's still invested and still gaining interest.
Yeah, so they use your money as collateral. It's in their earning. Then with that collateral, they'll lend you the insurance company's money at usually the same interest rate, maybe a slightly different interest rate, right? You can then use that money, didn't take credit, it just took the collateral. Your money still is interest. You're paying interest on this money. You pay that money back. This money was always earning, so you never interrupt the compounding curve, and you have flexibility. If you don't pay the loan back, they subtract it from your death benefit tax-free.
It's just an insanely good deal. And I try to explain this. I do have some entrepreneurs. I know you kind of cater to entrepreneurs, really. And for entrepreneurs listening to this, it's like, if you need equipment or something for your company, you can literally use your cash flow banking money and then have the company pay you back plus interest. And you can earn income from your company paying you back on a loan that you gave yourself. Like, it's staggering.
Right.
Yeah. So, I mean, I wanted to touch on that in case people didn't know about it. But again, it's like, it's the peer pressure thing that it's the same with nutrition. People just come at you with these stigmas and all these different things. And the other thing is what was great about the Bank on Yourself book, because I think you were talking about some percentages there, is she really hammers the point home, like chapter after chapter after chapter, of the stock market returns over time versus these insurance policies and how astronomically close they are without that risk. So look at coronavirus, like what it just did to the market. People got killed,
Yeah.
So how do you feel about that? The what just happened in the market? Like, do you see that? That's one of the questions we have from people too, is do you see that as a real correction or just fear-based sell-off?
Look, man, we're at a very fragile place for a long time in the market.
Yeah.
So it's going to have exaggerated movement when things like this happen.
Sure.
If it wasn't so overvalued, we wouldn't see that level of exaggeration. But it's overvalued.
Yeah.
So do people lose their shit on stuff like a virus way too fast? Yeah. Like, I was supposed to fly to Asia and go there for a month and take my son. I just moved the trip because I'm not worried about the coronavirus. I've got a good immune system. I am worried about getting quarantined, however.
Exactly. I totally agree.
So I moved the trip to November. I mean, which means I think that this should pass overall. But yeah, man, we're just at a place where we've been going at such a high and hard rate for a long time that doesn't make sense, that we're going to have something like that have a more quick impact.
Yeah.
And, I've been putting out videos that 2020 was the year of the recession. I didn't know it would be a coronavirus that would, put that much of a damper, but I think it was going to happen whether we had an incident like the coronavirus. But, we have anything like all these trade agreement issues. It's a fragile place, man. We're valued in the market because people are putting money into it, not because it's actually worth that. It's worth that because people keep funding their retirement plans without question. Not
100%.
It makes sense.
Absolutely, man. It's crazy too. An amazing thing that happened because of Wealth Factory. I think it was sometime over the summer, or maybe September or something, but I had a 401k traditional because I had an employee match. I had a Roth IRA. I had some money in stocks and everything. I went everything to cash. And I had a long talk with Tim about it. He's like, based on your age, your income level, how your company's doing, now would be the time to do this and pay the penalties or whatever. I mean, could not be happier that I did that just based on what just happened and went into something like whole life, just a far more. But again, the 401k is a sacred cow, man. People think think we've been funding 401ks since Adam and Eve when they're really like 40 years old. you know?
And the real reason they came out is pretty fascinating, because they came out more because pensions failures,
Right.
than because it was the right plan. Like, you got to realize companies, like what happened was companies wanted to recruit high talent. They wanted to recruit the best. In order to recruit the best, they created pensions. Hey, come work for us. We want to get you here. We'll pay you after, you know, your working years are over. And this is a time where people aren't living at the age that they're living to now, especially in America. So what happens is people find out about these executives getting pensions. They're like, hey, that's unfair. I want pensions. So then we get the government. Then all of a sudden everybody's getting pensions, right?
Right.
And by the way, the reason why pensions got decimated is because they were reliant upon the stock market performing at 8.7%, I believe.
Wow.
8.4, and it didn't. Everybody says it averages 10. So that's why those things collapsed, is because the stock market, they were running off numbers of the 90s, which were astronomical and a pipe dream today. So it was the stock market that really killed the pensions more than anything. You know, and it's like, I read a book called The Fate of the States. Pensions collapsed certain towns in California because they had to pay the pensions before they could pay the police force.
Wow.
And it really created major problems where some of these places you could only report a crime if it was in progress. And I mean, it was crazy. You're right. So as we look at this, the movement was companies couldn't afford the pensions. So they started saying, we'll match on you pay, you know, rather than a defined benefit like a pension where we're telling you what you get in the future, you can contribute and we'll match your contribution. It's less responsibility on the company, more on the individual. And the problem is it gives people false hope. They think, oh, cool, I'm going to fund this and I'm going to be able to retire. 95% of people can't retire. So they're funding it. They're now involved in the market. They know little about the market, just like their companies knew little about the market. The market has continued to be overhyped and underperforming. And I've had people say, there's more 401k millionaires now than ever. I'm like, oh, really? Well, let's talk about that. Let's dissect that for just a minute. You said you need $5,300 to eat organic and live pretty healthy, right?
Sure. Yep.
If you had $1 million right now, based upon the interest rates that are out there that people can earn in a 401k, guess what the average amount is being paid out of a 401k to a retiree with $1 million right now?
I have no idea.
$25,000 to $30,000 a year. So
Whoa.
you're a millionaire on paper, but not living like one.
No.
These interest rates are so low. So
I mean, that's less than half of what I would need.
Yeah. So you have to now have $2 million. And by the way, that's what if in 10 years from now you need to adjust that for inflation?
Sure.
Maybe $3 million that you need. So it's a moving target. It's not performing. And yet people still believe in these plans, but they've failed people far too often. The first thing that it tells people on is it lies to them and says you're going to save tax. Well, how are you going to save tax? You put money into the plan pre-tax, but you have to pay taxes when you pull it out. What happens if taxes go up? The government's $23 trillion in debt right now. What if they raise taxes in the future?
Mm-hmm.
You know, we've had over a 50% highest tax rate on average since the inception of the taxes in 1913. So from 1944 all the way to 1981, the tax brackets were above 50%, right?
Yeah.
So like right now we're historically low. The second thing is, if it takes more money because of inflation to buy things in the future, you're going to pay more tax because you got to have more money to buy the same things. So you're paying more in tax. So that's another issue. And here's my question. Do you want to live off less money in the future? Like that whole notion that people can live off 70% at retirement. Do you want less money in the future? That seems crazy. Yeah. So I don't think people are going to be in a lower tax bracket. So all we're doing is delaying our taxes, not saving our taxes in these plans. We're not getting cash flow along the way. We're investing in a market that has been underperforming for a decade now. Really, since 2000, the stock market's been a disappointment. So it's really been 2 decades. Yeah. We've had small run-ups, but overall, the returns are not close to what people think when they look at the actual returns. Right. And by the time we account for fees and inflation, it's been horrendous. And so I think that it's just something that people are buying into the 1990s in the year 2020. And it's going to disappoint them severely if they don't question it. And they'd be better off paying off their loans. They'd be better off putting some money in savings accounts so they have a little bit of liquidity. And they'd be better off putting that money in themselves so they can earn more money and then go to cash flow banking to store their money and then invest in something that they understand beyond that. Yes. Where's the place you can invest? Like, you know how to invest in health and nutrition companies if that's where you really want to invest.
Right.
You probably don't know nearly as much about, I don't know, maybe you do. I don't know shit about technology. Like, I'm not a teenager, so I can't keep up with all the technological trends. So I don't think I'm a good investor in that side. I'm good at investing into infrastructure with technology in my businesses, not at predicting which technologies are going to blow up and do well.
Yeah, you're not going to go to Silicon Valley and try to invest in startups by meeting with founders or things like that. But I mean, the path you just outlined was incredible, because I mean, you think about the 1-2 punch of that as well. People are funding these 401ks and their lifestyle of debt and all this by scrimping and saving with accumulation philosophy. So imagine scrimping and saving 35, 40 years. Then you retire only to find out that you only have enough money to scrimp and save until the day you die. Like, that's insane.
Right. And it happens almost all the time, dude. That's the problem. That's what people are facing. The article that changed my life, there's an article that changed my life in 2002. Because look, admittedly, 1998, 1999, I was a believer in the stock market. I mean, it was crushing.
Sure.
And but then in 2000, it started to go down. I didn't really know why or how long it would last. I was trying to learn about it. And then in 2002, there was an article. It was about this guy that was at the company that you mentioned earlier, Mass Mutual. And he was executive VP of their retirement services. So he's basically as high up as you could be on the retirement side of things. He retired in the year 2000. He took 10% of his retirement funds and he bought like a small company. And then he put the other 90% in aggressive funds and lost so much over the next 2 years that he was now driving a limo to earn a living.
Wow.
And that's the person that's supposed to be able to tell us how it works.
Right. It's crazy, man. And it's scary too, because you laid out such a perfect path there. So if we get from paying off debt and loans and everything to investing in yourself to maybe eventually cash flow banking, right? And then investing in something, this is why I love your concept of investor DNA. Because what I found, and I want to dig into these questions from people, because what I found is everyone who has no experience in finance or investing of any kind or entrepreneurship or anything, they just go, well, I want to be rich. So 401k and I want to buy real estate. And I'm like, but you know nothing about real estate. What do you know about real estate? And they're like, well, nothing, but that's how people get rich. I'm like, no. Real estate keeps wealthy people wealthy. It very rarely makes them wealthy, right? Am I right about that?
I got my ass kicked in real estate because I had that same belief as the people you talked about.
It's so common, man.
If you're not going to treat it like a business and it's not a full-time gig, prepare to lose money.